Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. Equity volatility measured by the VIX Volatility Index has increased this year and resulted in financial advisors looking for investment strategies that might help reduce investment risk, might make it easier for their clients to sleep well at night, you name it. Well, I have on the perfect guest to talk about low volatility strategies and how technology is changing the way some asset managers manage money. But before we get started, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, enough from me. Let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to Brad Roth. Brad is the founding principal and the CIO at THOR Financial Technologies and is also host of the very popular Behind the Ticker podcast. So, Brad, after you're done, feel free to critique me here after we're done, not during, but maybe
Right.
after on the
Well,
podcast.
I'm not sure. I'm not sure, Ryan, that I'm too much of a star, but
Yeah,
I'll take the entrance.
no, you are. Brad, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Thor Financial Technologies?
Sure, and Ryan, of course, always good to be with you. We met last week and had a nice conversation, so
Mhm.
it's a pleasure to be on your show. Yeah, I guess we could start with me. I'm Chief Investment Officer at THOR Financial Technologies, born and raised in Pittsburgh, Pennsylvania, which everybody saw the rain that we get during the U.S. Open yesterday. So it's been quite rainy here. I've got two lovely kids,
Okay.
and so I spent a lot of my time either taking them to travel soccer or tennis or skating or whatever. But I also have a dual role as well, which I'm also the Chief Investment Officer of UX Wealth Partners. They're a
Okay.
TAMP. I spend a lot of my time doing due diligence on up and coming emerging AI managers. And then, as you kind of put it, Behind the Ticker podcast, we've done 90 episodes with ETF managers and portfolio strategists, so have a deep understanding of kind of what people are trying to do in the marketplace. But really, how I got here and started Thor was it's funny. I'll actually go way back. We were one of the
Yeah.
first high schools and middle schools in the country to get laptops issued, which is odd in Western Pennsylvania. It doesn't seem like a tech forward town, but
Right.
um, some funding from Mr. Arnold Palmer, which another golf reference, got us all laptops. And um, I started trading when I was in junior high and in
Right.
high school. I opened a little TD Ameritrade account, and it was you know, one of the things I absolutely got infatuated with. Went to college, majored in accounting, and was I would say the odd kid with three monitors in his dorm room, trading penny stocks, doing all these different things, but really taking it all in and learning. The nice thing about that, it landed me a job in an outsourced family office. I got to meet some really interesting people. Ran into a PhD in statistics as well as some engineers, and got everything infatuated with building kind of models and automated investments that are going to be a little bit differentiated than traditional. So we
Very
launched
cool.
Thor originally as a hedge fund. Now we went to retail in 2020. So we have model portfolios that are delivered via TAMP. And then we also have two ETFs on the marketplace, which I'm sure we'll talk about a little bit, which is our index
Yeah.
rotation as well as our low volatility sector model.
I love it. Great, great story there, Brad, and your evolution to the space. With your podcast, I'm sure you are very busy with ETF issuers, with the way ETFs are blowing up right now, and how many new issuances are coming out to the market.
Yeah, you know what? It's been really great. There's so many really unique and cool ideas happening in the
Yeah.
ETF space right now. I mean, I believe active just passed passive in terms of number of issuance. So we're having a lot of really interesting conversations. And yeah, the ETF space is extremely exciting, and we're learning and seeing new products I mean, now it's a daily basis, not a monthly or
Yeah.
weekly cadence, but no, it's exciting, and it's kept my schedule busy with guests and learning about new products and strategies out there.
I bet. You know, you started by talking about technology, right? And that's really where you kind of started, right, with their hedge fund and back in high school with technology. How has technology really changed the way asset managers like Thor manage investments? You know, I feel as if technology has really changed the wealth management space and financial advisors. You don't hear a whole lot about it on the asset management side. How has it changed?
Yeah, and no, I love this question, Ryan, because you see all this change. You brought up the wealth management space, but let's look at how technology has changed driving a car to a destination you didn't know how to get there, right? You started with a big map, then we invented the internet. We had MapQuest. Now we've got, Waze in our car that not only tells you how to get there, but tells you the most efficient route, whether there's traffic, whether there's a police, right? So
Yep.
technology has done all of these wonderful things in so many sectors. And you're right. I feel like we've had a little bit of a lag in terms of really adopting it in the asset management space. And I think one of the reasons why is people have held on to these tried and true ideas that they're learning in school, they're learning
Yeah.
taking their CFA, and these are really brilliant types of ideas, right? Modern portfolio theory, factor-based investing. How can we find little specks of alpha here and there and
Mhm.
drive really good risk-adjusted portfolio returns? We're starting to see technology utilized in those kind of older ideas. When
Okay.
we talk about technology, we're saying, okay, how can we implement ideas in physics? How can we implement ideas in engineering that aren't mathematically based?
Yeah.
And how can we implement those in our client portfolios? And I'm happy to talk about that deeper, but we want to think about taking this challenge, which is a dynamic market, and trying to utilize dynamic technologies to try and solve it, rather than trying to use, linear mathematics or statistics and probability to try to come up with the answer.
Yeah, that's fantastic, Brad. You know, at Zephyr, we focus a lot on, um, modern portfolio theory, creating optimized portfolios, and it's on technology, but data, right? Data is
Right.
kind of the key piece there. And we all know data, 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 and now we're getting all these alternative data sets, whether it's Reddit data, fund flow data. How does that change? Is that really kind of driving the way we look at technology? You got to use technology to really harness the power of that data. Is that where you're seeing it also?
Yeah, I mean, a lot of the due diligence and managers that we're seeing, whether it's talking to ETF issuers or talking to SMA or AI portfolio managers, you're right. The data that they're getting is not from a traditional source.
Mhm.
Maybe they're getting data from FactSet. Everybody's getting data from FactSet, or getting data from Zephyr, or getting data from a multitude of different places. But you're right. There is so much underlying information you can find on stock twits, on Reddit, and trying to find certain, maybe building sediment indicators based on that. I mean, people are really trying to tap into alternative sources of information, and it's leading to, different ways of thinking. And really, for the end advisor, it's creating a differentiated solution for their client, which I think is the most important.
Yeah, you're fantastic. You're exactly right. How does Thor leverage technology to separate yourself from other asset managers? Like I said, I still think asset managers, they're trying to harness technology. Seems like, you are kind of at the forefront. How do you use it without giving your secret sauce away?
Sure. Yeah. No. Yeah. I mean, we do a number of different things. I'll give you a little bit of the hypothesis of how we view the market, and then a little bit of the, well, you can call it secret sauce. But really, the market fundamentally changed with the advent of the internet and data. Right before, I watched this old documentary. It's really hard to find on an old hedge fund, Paul Tudor Jones. He seems to want to take it down from the internet, but if you can find it while it's up, it's up. It's like 48 minutes long. And he's doing technical analysis and quantitative analysis on, grid paper, right? He's
Yeah,
drawing the data. Now I'm getting every single data, the tick of data and everything instantaneously, right? And that fundamentally changed how people are approaching markets. And so our hypothesis and the way we view markets is when everything went digital,
yeah,
right? You can now visualize any piece of data in a chart. right? So you can pull up, I'm on TradingView or Bloomberg, and everything is charted and it's completely live. And when you really take a step back and look at any security, it's nothing more than a waveform, right? It has a defined starting point, it has no defined ending point, and it goes up and down along the
Yep.
way. So what we want to do is use technology to read, react, analyze that particular waveform for that particular security. So the cleanest example I can give you about the technology that we're using is you travel a lot, I travel a lot. We sit on the plane, we put on our noise canceling headphones, right? The sound of that jet engine completely goes away. And the reason for that is there's a piece of engineering technology and physics technology in that headphone that is bringing in the sound of that jet engine, the
Yeah.
sound wave. It's reading it, it's reacting it, and it's putting out a counter wave and it dulls the sound. We're doing the same thing with market data. We're analyzing, reading the waveform of the cycle of whatever asset class we're looking at, and we're reacting to it whether we want to be long that asset class or maybe we don't want to be long that asset class. And at a very high level, that's how we're using it. Everything we do is completely 100% fully automated. So
Okay.
the systems run, it brings in all the data for us. We built all the proprietary information that it will read and tell us very simply whether or not we want to be in or out of something. Um,
Okay.
and that continues to run on every single tick of data, every single day, on every single asset class that we're trading for our clients.
Fantastic. So do you, and I love the examples too. It makes it so much easier to understand. I'm a firm believer of KISS, keep it simple, stupid. So
Yeah.
the more you can do that, the better. Um, Do you think though technology, and you talked about it, technology back in the day where you're charting, and data's not as readily available, do you think it's made markets more efficient though when data is out there, snap your fingers, you can get it anywhere, make it more efficient, harder to find alpha?
You're hit the nail on the head, Ryan. I think with the with data, right, we've seen markets become a lot more efficient. With AI, it's going to become almost super efficient, right? So when AI is going to be able to dig into all these data sets, find all the prior inefficiencies, which everybody else is going to end up finding
Yeah.
eventually and arbitraging each other out, markets are going to become extremely, extremely efficient. Um, One of the reasons why I like what we do is at the end of the day, markets still have to go up and down, right?
Yeah.
And they're still going to exhibit, key factors of momentum or velocity change. And those are things that we believe a robust tool and a piece of technology like we've built is always going to be relevant. But I see, to your point, with the advent of more data, with AI getting better and better every single day, the arbitrage opportunity to find alpha in factors is going to become very difficult. And I think it's really going to kind of emulate or change over time as the markets, you know, I guess to bring it back just a second, is the market feels fundamentally different over the last 10 years, right?
Mhm.
It seems to kind of want to grind to the upside. And then all of a sudden, every 12 to 18 months, you get this 25% snap drawdown that happens in 5 or 6 days. And that's very different than the market of 25, 30 years ago, your grandfather's market, right? You got 7, 10% drawdowns. It was normal. Now it's like, we're going to take all the risk off the table in a week and then we're going to put it back on. And so that's the types of things that access to high quality data and
Yeah.
technology is doing. It's making markets faster, but
Yeah.
all the more while being more efficient.
Yeah, I was just going to say that those market moves we have now are so much quicker, right? And it goes back to we could have this conversation for, multiple episodes, but long-term investing makes it like time in the market now. In grandfather's market was a bad idea. Now it's a terrible idea for how quickly markets move. Markets are resilient. And like you said, it's like ripping the band-aid off. Let's just get the risk out of the market now and move on.
Well, it makes it harder, I think, for the end client and for the advisor because
Yeah.
they become very stressful situations very quickly. And clients get really scared.
Yeah.
At the end of the day, they might think that, they're willing to take on risk of the market, but at the end of the day, seeing 20 to 15 to 25% of your money disappear in 8 days is hard to see, right? So it makes this client education, it makes putting products and solutions that are maybe a little bit lower volatility and can dampen that drawdown in the portfolio a good idea. But it does pose a challenge for end clients where, I have a lot of conversations with advisors, and in those instances, the phone is ringing off the hook. And as you know, an advisor's number one or number two priority is educating and helping his client with planning, and also keeping them in the market and
Yep.
educating them that don't sell low and get scared. And but those conversations are becoming a lot harder given that market environment.
Yeah, you're exactly right, Brad. I recently just did an article a few weeks ago about the importance of staying in the market, and it's the hardest conversation for a financial advisor to have. But, and you talked about it, now, we'll see a really quick drawdown, 20, 25% over a week, but those are pretty common and throughout a mid-year correction. But though it's very oftentimes that year ends up 10, 15, 20%. We all have a very solid return for the entire year, and you often forget about those 20% drawdowns, but they happen.
Oh, you think about them really quickly, especially when you have, most of the market invested in the Mag 7, and that train
Yep.
that just won't keep stop. That train is heavily on the rails, and is continuing to go. Um, I think though too, I mean, not to play a little bit of devil's advocate, it's at some point, I don't know when, you don't know when, it's not going to be that V shape. And, that's when you're going to see separation from, an okay advisor from a great advisor, a good strategy from an okay strategy. And at some point that day will come. We just haven't seen it for a very, very long time. I mean, I, COVID was over. It was what, 35% down, and then retraced in what, a matter of 70 days, 75
Yeah.
days.
Exactly. Exactly. No, very good point. We talk about how it typically bounces back, but you're right. One of these times it's not going to bounce back as quickly, and we're going to wonder what happened.
Right.
Why not?
It's going to take 2 years, like, 2008,
Yeah.
instead of, uh, you know,
Yeah.
15 days.
Yeah, exactly. So I'm really perfect segue. I want to talk about some low volatility strategies. We're talking about investment risk, low vol, especially now with volatility picking up. What type of volatility or investment risk are you trying to limit in your low volatility strategies?
Yeah, it's a very simple answer. It's drawdown risk, right? There's the low volatility factor out there, which is really designing to build a portfolio around low beta, right?
Mm.
What we have witnessed is, and again, perfect segue, in all these recent drawdowns, everything is selling. It doesn't matter whether it's low beta or not. So if you go back to COVID and look at your traditional low vol funds, they were down as much, if not more, than the market. And then because they have low beta exposure to the upside, it takes longer to get in. What we really decided to do was, if I was a client looking at what low volatility meant, I would think less risk and less drawdown.
Yeah.
So what we really decided to do was, we wanted to build a portfolio or a set of strategies that had full beta capture to the upside,
Yeah.
but had the ability to be active and get defensive during periods of volatility or probable volatility.
Hmm.
And so our whole philosophy is, and you've heard this 100 times, is we want to win by not losing. We want to take those worst 10 days out of the portfolio, and we also want to take the best 10 days because they seem very highly correlated. And if you do the research, if you take, the best and the worst 10, you actually end up with a better compounded return than
Yep.
just purely buy and hold. So we want to be getting clients out of the way during periods of volatility. At that point, slightly before that point, they want to pick up the phone and call their advisor, right? And say, this is getting a little difficult. We need to start selling securities. And we want to do that in an unemotional and automatic way so that they don't have to make that decision. But to directly answer your question, we think of low vol as drawdown mitigation, rather than kind of a factor, which is, we want to get, 80% of the beta upside, 80% of the beta downside, because that's really gotten skewed with how markets operate in downside vol now.
I'm so glad you brought that up, Brad, because when I started in the industry 20 years ago, and maybe even more volatility, it's all about standard deviation, right? Risk. What's your risk standard deviation? Well, now, Brad, give me all the upside deviation you want, right? I have no problem with upside deviation. It's that downside deviation. When I think of investment risk, it's losing money, right? It's not the volatility across the mean from the mean standard deviation. It's me losing my money, right? That's what I want to reduce. So I'm really glad you brought that up because at Zephyr we do a lot of research with the pain indexes, pain ratio, and like you said, you win by not losing. It's a
That's what we're trying to do, and we've done a good job so far of doing that. It's at the end of the day, if you really are empathetic to the end client, this is their life savings. They look at it as much as they look at it as their investment account. They look at it almost like their savings account, their retirement account, their emergency fund, all of these things wrapped into one. And at the end of the day, they don't want to lose money. They would much rather get 15% of the upside when the market's up 20 than get 20 but lose 20. And they are more risk adverse than I think most advisors seem to give them credit for.
yeah. And you mentioned this too, and just kind of go along with that point about, beta. A lot of time, I think it's a misconception too. When you think of low volatility strategies, it's like, well, I'm giving up some of the upside for downside protection. And the markets are rallying, the markets are up 20, 25%. And then you look at these strategies, oh, it's a drag on my portfolio. Is that a misconception? Or what do you tell advisors about who think, well, there's limited growth potential in these low vol strategies?
I think in traditional low vol strategies, I think they're pretty correct. I don't. I think the misconception there is none. I think it's very valid. Traditional look now. I'll say that with a caveat. In the last 5 or 10 years, we've been heavily driven by growth, right?
Yep.
Low beta is traditionally there's a lot of value inside of these low volatilities, low beta strategies. At some point, value is going to come back, right?
Yeah.
And so you're going to have low volatility outperform. And so it's this give and take. But I think that idea is true. Traditional low vol, you're going to miss out on some of the growth. What we tried to build, let's take our index rotation strategy. It invests in the S&P 500, the QQQ, and the DIA equally weighted. When we're long the market, right? We're going to get upside market exposure.
Yeah.
We're not sacrificing any beta or any upside because we're just long those markets. Where we are going to provide value and alphas when we start moving to treasuries if things are really, really bad. Where we get hurt is if we're wrong, right? Um,
Yeah.
but I think the idea that low vol can be a drag, traditional low vol can be a drag, is true in a lot of instances, especially the instances that we've been in, where growth is just completely dominated.
Yeah. No, but also too, do you feel as when you do think of low vol, you think of defensive sectors, utilities, and stuff like that? Do now you're getting very high quality names, whether it's Apple, Microsoft that are, driving markets. Can you still include those in a low vol strategy too, since they're high quality?
I mean, you definitely could, right? I'm not a factor based, index builder, but I think you definitely can. But if you look at a lot of how your big low volatility strategies are, they're a lot of the exposure is going to be more value based,
Yeah.
high quality, which is fine. I mean, that's investors want that exposure.
Right.
But they're not going to be able to keep up when Nvidia and some of these others are ripping market cap weighted indexes. And it's someday value is going to have its value and utility, and everything is going to have its place in the sun, right? It
Yep.
it it always rotates around. We just haven't had that experience for kind of quite some time.
Yeah. Fantastic. How can financial advisors incorporate low vol strategies in their client portfolios? Is it like more of a satellite approach, or should maybe like a low vol strategy be the core holding? And then, I'm a firm believer the nine style equity box had its day. Right. You could still use it. I think there's
Yeah.
still purpose in it, but how can financial advisors incorporate low vol strategies?
I think the building a very intelligent, strategic, passive investment, um, diversified portfolio is the foundation, right? And then I think satelliting low vol against your large cap equity exposure, I think makes a ton of sense. Maybe 10% the exposure there. I also think we're entering this point in time where there is that ability, especially with the ETF wrapper, to get some active in there, right? So I think building 70 or 80% of your portfolio to be buy and hold long only, great. Love the foundation. It should stay that way, right? 20%, 30% of a portfolio, get some low vol in there, get some active in there, get some AI driven strategies in there, get some alternatives in there, get some different things in there that can move around, be active, and take advantage of new ideas. I think is going to be the best way to deliver portfolios fully diversified. It's a diversification of ideas, not just asset class. I think is what ends up winning in the long term and offers the less stressful investment experience.
Yeah. Let your clients sleep at night, right? Let them sleep at night. Fantastic, Brad. Let's tie it all back together. What's the future of asset management look like? You got data, technology. We started talking about technology, all this stuff. We've got, the generational wealth transfer, younger investors. What's it all look like?
I wish I'd known. I think that we're going to continue to see the growth of active ETFs. We're going to see a transition probably into tokenization
Okay.
as you start to get and tailor to the younger generation who's a lot more familiar with crypto. They're going to want to see asset management strategies tokenized, and that I think is coming. As far as the investment management or asset management front, we are going to continue to see a boom in AI, and it's going to be used in a variety of different ways. We're going to see, I think, leaner teams. They're heavily reliant on technology to help make investment decisions and get really unique and cool products that are differentiated out to the market. But all in all, I think we are, as we talked 30 minutes ago, right? This space hasn't seen the technological advancement it probably should have, like everything else. And I think we're probably at the precipice of people are starting to wake up to the fact that they're going to need to modernize their thinking around investment decisions. And I think we're on the wave of that. And we're going to see a lot more of that over the next 24 to 36 months.
Yeah. Fantastic, Brad. I knew it was going to be a fun conversation. I love the insight based on our conversation we had at Edge. Um, a lot of fun. Where can our audience get more information about THOR Financial Technologies, the podcast, everything else you're doing?
Sure. And Ryan, thank you so much for giving us the time and opportunity. I love being on your show. Um, you can learn about our company at thorft.com if you want to see our ETFs and our ETF lineup. You can find that at thorfunds.com. I'm very active on LinkedIn because we have the show Behind the Ticker. It goes out on Mondays on etfcentral.com. And then also you can find it everywhere you listen to podcasts, Apple, Spotify, YouTube. Pick it, it's there. But if you're looking for insights on what's going on in the ETF space, you're looking for cool product to maybe add to your already diversified model portfolio, I'm doing the due diligence for you. So you might as well go in and do the 30-minute listen on any ETF product you might have some interest in.
Brad, it's been an honor. I love it. I've watched a podcast. Great insight. A lot of fun conversations on there. It's been an honor. Thank you so much, Brad, for coming on the show. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe to those channels and follow us on LinkedIn. Thank you, and have a great rest of your week.
Thank you.
Brad.